Everybody loves dividends. I mean, what's not there to love about receiving passive income month after month? And if that passive income increases each year, that's even sweeter. When you are first drawn to dividend investing, your focus is probably on the yield a stock pays. And it's natural to place a lot of emphasis on the dividend yield. But for me, a more important aspect of dividend investing is stability and consistency. Because while I like a high yield just as much as the next dividend investor, I much rather prefer my dividend income to be stable and consistently growing. And the best place to look for stable and consistent dividend growers is the Dividend Kings list. Currently, we have 54 Dividend Kings. To become a Dividend King, a company must increase its dividend for 50 consecutive years. That's right, 5 decades of dividend growth. I'll get into the Dividend Kings in just a moment, but what I wanted to focus on today are future Dividend Kings. Companies that are well on their journey to earn a spot on this coveted list of elite dividend-paying stocks. I found 17 companies that can become a Dividend King in the next decade if they continue paying and growing their dividend payouts. Some of these companies can join the Dividend Kings list very soon, while others still need a few more dividend increases to get there. I'm going to highlight 5 of these companies in this video, but you can download a free PDF report for all 17 companies. There's the link in the description below. Number 1 on our list today is RLI Corporation, ticker symbol RLI. The company currently has a 49-year streak of dividend growth, and it is expected to announce their next dividend increase in June of this year. If it does, it'll be the next stock to join the Dividend Kings list. RLI currently pays a pretty attractive dividend yield of 3.51%. It's been growing its dividend at a decent pace of 4.8% during the last decade. And to boot, it has a very low payout ratio of just 15.1%, meaning there's plenty of room to keep its dividend growth streak going well into the future. I'm going to jump around the list a bit here, down to future Dividend King number 4, which is the Clorox Company, ticker symbol CLX. Clorox currently has a 48-year streak of dividend growth, and it is expected to earn Dividend King status in August of 2026. Clorox currently pays a 3.31% dividend yield. It has a 10-year dividend growth rate of 5.2%. However, for the last 2 years, the company has only bumped its dividend rate by 1.7%. The likely culprit of the below-average dividend increases is a rather high payout ratio that currently stands at 131.9%. A payout ratio above 100% is cause for concern, and Clorox's payout ratio has remained above 100% since 2022. A mature company like Clorox can sustain its dividend in the short term and even continue to increase it, even if the dividend per share exceeds earnings per share. But this certainly isn't sustainable in the long run, so investors should monitor the payout ratio going forward to make sure it trends back below 100%. Future Dividend King number 5 is the McDonald's Corporation, ticker symbol MCD. McDonald's also currently has a 48-year streak of dividend growth, and it is expected to become a Dividend King in December of 2026. The stock yields 2.36% right now and has a healthy 10-year dividend growth rate of 7.8%. Looking at the annual dividend increases, we can tell that the dividend growth journey for McDonald's isn't slowing down, as the last 3 annual increases have all come in at 7.8% or higher. And to go along with this healthy, inflation-beating pace of dividend growth, McDonald's has maintained a reasonable payout ratio that stands at 59.2% today. Future Dividend King number 6 is Medtronic plc, ticker symbol MDT. Medtronic has a 47-year streak of dividend growth, and it is expected to become a Dividend King in July of 2027. The stock pays a dividend yield of 3.06% and has a 10-year dividend growth rate of 8.8%. For the most part, the individual dividend increases from the past decade have been rather healthy, except for the last one that came in at just 1.5%. Medtronic's payout ratio has crept higher during the last decade, reaching its peak in 2024 at 99.7%. This could be the cause of the below-average dividend increase last year. On a brighter note, the trailing 12-month payout ratio has trended lower to 84.8%, which could mean that there is room for a better dividend increase from the company this year. Of course, we'll have to wait until July to find out. And future Dividend King number 12 is Aflac, ticker symbol AFL. Aflac has a 42-year streak of dividend growth, and it is expected to become a Dividend King by February of 2032. It pays a dividend yield of 2.22% and has a very strong 10.9% 10-year dividend growth rate. Its dividend growth history is a bit bumpy, with some years only seeing increases of 3 to 5%. But there are a handful of years where the company raised its dividend by nearly 20%. Aflac has a payout ratio of just 20.7%, which tells us there is plenty of room for its dividend growth journey to keep going until 2032 and beyond. If you want to know who the other 12 future Dividend Kings are, you can download the full PDF with all 17 future Dividend Kings. Let's now switch gears and talk about the actual Dividend Kings. As I mentioned at the beginning, there are 54 Dividend Kings right now. On average, they pay a 2.75% forward dividend yield, and while there are a few low yielders on the list, there are also a handful of kings that pay yields of 4%, and even a few that pay more than 5%. But to me, a more important consideration than the current dividend yield is how attractively valued each Dividend King is, and what type of total return it can deliver in the next 3 to 5 years. I created a Google spreadsheet to track and value all of the Dividend Kings. This spreadsheet is built on a dividend yield theory valuation model, and with the help of a macro, I can crunch this valuation for all of the Dividend Kings anytime I want. It takes a few minutes for the macro to run, but at the end, I can filter the file for just the potentially undervalued Dividend Kings. I can also see how effective dividend yield theory has been as a valuation metric with a built-in historical performance test. And most importantly, the spreadsheet automatically calculates a 3 to 5 year total return estimate. I updated the valuation just a moment ago, so let's see which Dividend Kings are potentially undervalued right now. Based on dividend yield theory, 33 out of the 54 Dividend Kings are potentially undervalued right now. Let me run down the list real quick. First up, we have ABM Industries that looks about 16% undervalued. Abbott Labs looks about 7% undervalued. Archer Daniels Midland looks about 36% undervalued. ADP looks about 1% undervalued. American States Water looks about 19% undervalued. Becton Dickinson looks about 21% undervalued. Black Hills Corporation looks about 11% undervalued. Commerce Bankshares is a little bit less than 1% undervalued. Canadian Utilities Limited looks about 2% undervalued. California Water Service looks about 25% undervalued. Farmers and Merchants Bancorp looks about 3% undervalued. Federal Realty Trust looks about 6% undervalued. H.B. Fuller looks about 29% undervalued. Genuine Parts Company looks about 17% undervalued. Hormel looks about 33% undervalued. Illinois Tool Works looks about 3% undervalued. Johnson & Johnson looks about 8% undervalued. Kimberly-Clark Corporation looks about 4% undervalued. Lancaster Company looks about 10% undervalued. Lowe's looks about 13% undervalued. MSA Safety Incorporated looks about 7% undervalued. Middlesex Water Company looks about 24% undervalued. Nordson looks about 33% undervalued. Northwest Natural Gas looks about 9% undervalued. Pepsi looks about 21% undervalued. PPG Industries looks about 23% undervalued. Stepan Company looks about 46% undervalued. SJW Group looks about 25% undervalued. Stanley Black & Decker looks about 30% undervalued. Cisco looks about 5% undervalued. Target looks about 43% undervalued. Tennant Company looks about 3% undervalued. And United Bankshares looks about 0.5% undervalued. If we take a quick look at the historical performance test, 27 out of these 33 Dividend Kings have favorable returns with the application of dividend yield theory. What this means is that if you invested in these Dividend Kings when dividend yield theory suggested they were potentially undervalued, you would have achieved better performance returns compared to investing in them during all the trading days during the last 7 years. Now let's filter this list further for just the Dividend Kings that are both potentially undervalued and have a decent total return estimate. The total return estimate is made up of 3 components: a discounted estimate of earnings growth, the forward dividend yield, and a potential return to fair value annualized over 5 years. If I set this filter for a 10% estimated rate of return, our list of 33 potentially undervalued Dividend Kings shrinks down to just 19. And I'm going to highlight just the 8 Dividend Kings that have an estimated rate of return of at least 12%. First up is Becton Dickinson with an estimated rate of return of 12.44%. Then we have H.B. Fuller with an estimated return of 15.86%. Hormel with an estimated return of 14.81%. Middlesex Water Service with an estimated return of 16.34%. Northwest Natural Gas with an estimated return of 15.45%. Stepan Company with an estimated return of 12.82%. Stanley Black & Decker with an estimated return of 24.03%. And Target with an estimated return of 17.53%. If anyone is interested in this Dividend King spreadsheet, you can check out my Patreon. I share this file, amongst other valuation and tracking sheets, with my members. There's a link in the description below. If you'd like to read more content from me, you can check out my newsletter, Quality at a Fair Price. I publish my stock research and other analysis each week, and you can have it delivered straight to your email. If you enjoyed the video, please do me a huge favor and hit that like button and subscribe to the channel. Thank you for watching, and see you next time.